Okay, let's kick things off. We're diving into a question I think a lot of homeowners wrestle with, something we pulled from an article someone shared. It's basically this. Can I refinance my home loan with the same bank?
Hmm.
So our mission really is to unpack the key things from that article, the stuff you really need to know when you're facing this decision.
Yeah, it's a super common question. And, the article gives a pretty straightforward answer right at the start.
It does. The short version is yes. You absolutely can refinance with the bank you're already with. They call it an internal refinance in the piece.
That's right. And the article points out some real upsides to doing that. Like, because they already have all your info, your details, your history, it often means, a streamlined application process.
Less paperwork, potentially.
Exactly. Less paperwork, maybe faster processing, too. That's what the reading suggests. And sometimes, they might mention loyalty perks or, and this is important for some, maybe even avoiding break costs if you're on a fixed rate.
Ah, right. But you'd need to check that specifically with them, wouldn't you?
Oh, absolutely. The article stresses that. You have to confirm any potential savings directly. Don't just assume.
Okay, so that's the convenience side. But here's where it gets really interesting for me. What are the risks? What does the article say about the downsides of only talking to your current bank?
And this is crucial. The biggest warning sign the article flags is ending up with potentially higher interest rates.
Higher rates, even though you're an existing customer.
Yeah, think about it. The reading kind of implies that if you're not showing them competitive offers from other lenders, well, their incentive to give you their absolute rock bottom rate might not be as strong.
Right. They figure you might just stay for the ease of it.
Precisely. And you could easily miss out on a significantly better deal elsewhere just because you didn't look.
Okay, so the rate is a big one. Who else?
It's not just the rate, though. The article also talks about limited loan features. Maybe the features your current bank offers aren't, the best fit for you now.
Features like what, specifically?
Well, the piece mentions things like a really good offset account, where your savings directly cut down the loan balance interest is charged on. That can save a fortune.
Daily compounding savings.
Exactly. Or maybe a flexible redraw facility letting you access extra payments you've made. Your current loan might be basic, while newer ones elsewhere have better options.
Gotcha. So the big picture risk, as the article puts it, is basically not receiving the best overall deal just because you didn't shop around.
That sums it up perfectly. The strong advice from the reading is you must compare. Get quotes from at least 2 or 3 other financial institutions.
And when you're actually looking at those quotes, the article highlights something important about the rates themselves, doesn't it?
Yes, absolutely vital. It draws a clear line between the headline interest rate and the comparison rate.
Okay, explain that difference again. It's key.
So the comparison rate, as the article explains it, tries to bundle in most of the main fees and charges with the interest rate. It gives you a much closer idea of the true cost of the loan over time.
Right, not just the shiny interest rate number. It includes the ongoing fees.
Exactly. Focusing only on the interest rate means you could miss how much fees add up. The comparison rate helps you see that bigger picture.
Okay, that makes total sense. So, thinking about what the article laid out, here's a question that pops up for me. If staying put seems easier, why wouldn't your current bank just automatically offer you their very best rate to keep you?
Well, based on the article's logic, it boils down to incentives, right? Unless you push them, maybe by showing them a better offer from somewhere else, the convenience factor is often enough to keep people. They might not need to offer their absolute lowest rate immediately.
Interesting. Okay, second question then, building on that. Beyond the actual percentage rate, how much difference can getting the right features, like that good offset account the article mentioned, actually make to the total interest you pay over, say, 25 or 30 years?
Oh, potentially huge amounts. The article highlights these features for a reason. An effective offset account working day in and day out can literally shave years and tens of thousands of dollars off your loan. It really shows why you've got to look past just the interest rate. It's the whole package, the rate, the fees captured in the comparison rate, and the features that fit your life. It's about long-term financial health, not just, what's easiest today.
So the core tension is really clear from the reading. It's that convenience of staying put versus the financial need to make sure you've got the best possible deal by actually looking around. The power, as the article seems to say again and again, really is in doing that comparison.
Absolutely. Which leaves us with a pretty important final thought, doesn't it? Does that feeling of convenience, of sticking with what you know ever truly outweigh the potential for quite significant long-term savings when you're dealing with something as big as your mortgage?
It's a critical question for everyone, and especially for Australian expats, maybe looking at their options from afar. To learn more about comparing internal versus external refinance options, you can check out Odin Mortgage.